Good afternoon. Welcome to Midcap Radar. I'm Reema Tendulkar. With me is Ekta Batra. It's a Friday afternoon and these are the top stories. Midcaps outperform large pairs on the last day of the week. Stocks trade firm. The Nifty near the day's high as capital goods and utilities lead the gains, even as IT sees some green. The consumer durables drag. Laurus Labs jumps a day after it reports a lackluster fourth quarter. The board declares a 60% dividend for FY23. PI Industries jumps on clinching a deal to buy assets for inroads into pharma. Analysts give the twin acquisitions a thumbs up and expect synergies going forward. Mid-cap tech players, Emphasis and LTIMindtree gain on positive earnings commentary. Emphasis tells CNBC-TV18 they hope to deliver margin expansion in FY24, and LTIMindtree is confident about double-digit growth next year. Indian Hotel posts a record profit in the fourth quarter. Management tells CNBC-TV18 they are far ahead of pre-COVID levels and expect to meet the margin guidance of 33%. The stock, meanwhile, is trading in the red. Godrej Consumer slips for the second day in a row. It has agreed to buy Raymond's FMCG business for 2,825 crore rupees. Raymond skids in trade, comes in for profit-taking after yesterday's up move. Hello and welcome to the show. Well, it is turning out to be a session where there is a slow and steady gain which is taking place in terms of the Nifty and the sensex, and we do have the broader markets which are managing to outperform as well. So the advanced decline ratio stands at a steady 2:1, over 2,100 stocks advancing and 1,300 stocks declining on the Bombay Stock Exchange. A similar type of ratio on the National Stock Exchange as well. As you can see, the advanced decline ratio extremely steady in today's trade. But let's talk about a couple of companies then. Embassy REIT reported what was a decent set of Q4 FY23 numbers. Revenue and profit witnessed a jump of 16% and 27% respectively, while the EBITDA margin contracted. The company has also announced a leadership change. Arvind Maya has been appointed CEO with effect July 1st. Vikash Kalolia will be the outgoing CEO. Embassy REIT now joins in to talk more about these developments. In fact, we have with us Vikas. Vikas, thank you very much for taking the time out. If you could first just take us through the reason for the management change as well as the exit.
Sure, thank you. First of all, great to be back on the show. So, it's been an incredible 12-year journey for me with Embassy REIT now and earlier with Blackstone. So I think the time is right for me to pursue other interests. Having said that, it's been an excellent run on the listed company. We have built a solid business at Embassy REIT and we have a great team in place. Arvind Maya, who will step in as the CEO, has been the CFO of the company earlier. And I couldn't be more proud of everything that the team has done. So I think I plan to dedicate more of my time to some of the other competing priorities that includes family, some new business interests, and fresh challenges. But all in all, I'll continue to stay as senior advisor to the REIT, and I'll continue to guide the team. And the business is in great shape, as you've said, on the Q4 numbers and the look forward. So I think it's the right time to pursue some of my other goals and priorities.
We look forward to hearing about your new professional passions. Vikash, hi, afternoon, Reema here. One change that we are seeing in Embassy's business model is a lower reliance on the technology, IT and IT-enabled services. And I think as a percentage of rentals, IT is now 15% versus, I think, more than 25% sometime back. Is this a trend that you suspect will continue? And how much do GCCs, Global Captive Centers, contribute to your overall rental portfolio?
Great. Thank you, Reema, for that. So absolutely, you're right. It's been a conscious strategy. So the global captives, as you're aware, they are these large global companies who are looking to set up in India. In fact, just last year, 100 of them set up centers in India. And the NASSCOM report expects another 500 GCCs to be set up over the next 3 years in India. So I think the global captives are coming into offshoring work and coming to India in a big way. And that is where we're seeing the demand come from. They also have higher propensity to pay. So as a strategy, we have shifted or pivoted towards global captives and large technology companies. And together they contribute about 70% of our revenues. And the IT services, while it still contributes a reasonable chunk of our revenues, has gone down from 25% to 15%. And that kind of shows in terms of our leasing numbers. We've done record leasing of 51 lakhs square feet this year. More importantly, we have added 44 new occupiers. Again, the same GCC occupiers, they continue to grow in India. And we are seeing that simply because India has this dual structural advantage, both of low cost and also abundant talent. So we continue to see this trend.
Sorry, I missed that number. GCCs contribute 70% to your overall portfolio now?
That is right, 70%.
And you are open for that number to go up from here on, as 500 more GCCs come in.
Absolutely, I think that's where the office demand is going. I think high quality landlords, occupiers want the total business ecosystem which we can provide. And by the way, these are the occupiers who have the propensity to pay higher rents. So it's a great business for us to kind of ensure we cater to these clients.
Okay. So what is your project pipeline looking like going into FY24, and what might your targets be?
Sure. So, we are investing heavily in our organic growth simply because we can see those underlying trends, whether it's the recession, in the developed countries, we see more work being offshored to India. Simply these companies want to, be more efficient and cut on costs. So seeing this, we are, as we speak, doing a record 79 lakh square feet of new development. All of this is within our existing office business, within our existing park. So we are not going and buying land. The potential existed. We are investing about 4,000 crore rupees. And when fully completed, the deliveries happen in a staggered manner over the next 4 years. When fully completed, this adds about 900 crores to our net operating income. So I think it's phenomenal opportunity. We are investing in growth. We can see the underlying trends of demand accelerating as corporates start taking decisions towards the second half of this year. And we are very positive both on the India office story and also the global captives you mentioned.
But are you a little skeptical? Do you expect any kind of headwinds to this target simply because, there are layoffs which are taking place globally? There are fears of a slowdown now. And we are in a high interest rate environment as well. Rates might not increase further, but they might still stay high. In that environment, do you think that there could be headwinds to these targets?
No, absolutely fair question. So let me give you a perspective here on both these things. We think both of them are actually an opportunity. So on the layoffs, there has been exponential hiring during the COVID. And now we are seeing moderation in growth. And some of the corporates are doing what we call corporate housekeeping, which are resulting in layoffs. But this incident is far more prominent in the West. India has been relatively insulated. And we are seeing on the ground that corporates continue to hire for strategic roles. Let's say whether it's R&D, product engineering or analytics. We see a lot of work coming to India, people being hired for that. I'll give you a small example of an American CRM cloud platform firm. They are laid off 10% or 7,000 of the global workforce in Jan. This is all public. And they have announced an India Center of Excellence where they are hiring 4,500 additional employees. So I think this is the trend. We expect to see more and more layoffs in the West will result in work being offshore to India, and India is pretty well suited for that. Now, let me come to the rising interest rates, and you're absolutely correct. The rising interest rates have impacted the global commercial real estate market quite dramatically. India has been a bright spot. Indian REITs have been fairly resilient. You've seen our Q4 numbers. You know what I think it will do, the rising interest rates, is it will also lead to rent inflation. And with rent inflation, we're already seeing Bangalore rents move 5 to 8% up over the last 2 quarters. And we also will see with the rising interest rates, supply coming down, diminished, which also gives us an opportunity because we are going ahead and doing the development and construction. So I think it will lead to consolidation. And we currently have about 2/3 of our debt at fixed. So we are somewhat insulated in terms of even the rising interest rate on our debt book of 15,000 crores. And we have one of the best credit ratings in the country. So I think all in all, yes, we are not 100% insulated, but we are very well placed to take advantage of the situation to the benefit of our unit holders.
So just to get some numbers on this point about how, while 2/3 of your portfolio and the debt that you've raised is fixed, you are still exposed to floating interest rates. So there is a note which says 4,100 crore worth of NCDs are up for refinancing. These were borrowed at 6.6%. And plus you've got floating rate debt of 5,700 crore, which will get repriced. Are these two numbers correct? And
that's
according
right.
to... Okay, so 4,100 plus 5,700. So we're looking at close to 10,000 crore. So now that the interest cost on this nearly 10,000 crore of liabilities has gone up, it could hurt your interest costs. It will push up your interest costs, and that could affect your payout. Is that something we should expect in FY24?
Yeah, so Rima, I'm not giving any guidance here, but your questions are absolutely fair. So let me lay out two perspectives. One, some of the debt will come up for repricing this year. We did a great job in managing our debt costs. We refinanced close to 6,000 crores last year, which resulted in pro forma interest savings. Having said that, as you mentioned, some of the repricing will happen. It's inevitable. But given we have a AAA balance sheet, rated balance sheet, we are only 28% levered on the company today. So we are very lowly levered. So we think we are well placed to access one of the best rates in the country. We have a very wide pool of investors in our debt book, from mutual funds to NBFCs. We have got listed bond investors. We have got banks. So I think we are well placed. But yes, this will go up. Having said that, I think there are multiple levers in the business. Obviously, the leasing spreads continue to be positive. So hopefully that makes up for some of the interest cost increases. And if I just take a step back, we look at our business, we don't manage it for a quarter or for a year. We look at it for the long term. So the way we look at the business is there are three priorities. Of course, manage the interest costs and ensure that the distributions continue. But more importantly, I think the leasing engine has to keep going on. We've done record deals this year. Over the last 7 years, this has been the best year. We want to continue that momentum. And two, we want to continue to invest in organic growth. We don't want to take a short-term view and just be far more defensive. We see it as an opportunity. Lastly, I want to mention on this point, it's a staggering number. We have distributed since our IPO in April 19, close to $1 billion in distribution, 7,800 crores. It's staggering given we had 2 years of pandemic and REIT is a new product. So I think hopefully the distributions are resilient, but we are very focused on growth.
All right, we're going to leave it on that note, and thank you very much. We look forward to your new endeavors as well as the new management coming on board. Thank you very much for joining in. That's Embassy REIT. Stock is holding up with a gain of around 0.5%. Time for a short break. On the other side, we'll be talking to the management of Supreme Industries, who will join it to discuss their Q4 performance. Welcome back. Well, plastic products manufacturer Supreme Industries posted what was a strong Q4. To discuss the numbers, we have with us Mr. Taparia, the MD of the company, joining in now. Mr. Taparia, thank you very much for taking the time out. It's a revenue growth which has come through this quarter. On a marginal basis, you'd have to say numbers are flattish on a year-on-year basis, but there's been a significant improvement which has taken place in terms of the gross margins as well as the EBITDA margins. In fact, at a multi-quarter high, if I'm not mistaken. Can you tell us what led to the margin improvement this time?
There was a good growth of volume. We had a good growth of the volume of 19%, of 15% in the last quarter. And we had some inventory gain. The polymer prices were coming down, have slightly gone up, and we could increase the sale of value-added items. So combined factor, our margins have improved in the fourth quarter.
So the reduction in there has been a reduction in polymer prices this time.
There was a reduction in polymer prices, but in this quarter there was some increase in the price of PVC. And as I told you, our value-added turnover also has gone up. So both things, all three things helped us to improve our operating margin.
Sir, you said volume growth of 15% in the quarter?
15% for the quarter, and overall it was 59%.
But sir, your top line is just up 1.5%.
Sorry?
So your top line, the overall revenues have only gone up by 1.6%, despite having a 15%.
Polymer prices have fallen.
Okay, so quite significantly. And what's the outlook then on polymer prices and volumes going ahead?
We believe that for the full year, the prices present bound on lower side.
Okay.
And on volume side, we anticipate a growth of 15% this year.
So therefore, FY24 revenue growth should also be close to 15%. mirroring the volume growth because the prices will be stable?
Revenue growth may be above 11,000 crore this year. Overall.
Okay, all right. Can you just tell us how exactly demand is panning out for you all in any case across segments? Industrial seems to have done the best for you all, though it's not that much in terms of proportion of revenue, but growth has been strong.
No, the demand segment for the year is opening itself. We believe the demand is going to be robust. Now the COVID problem is behind us. Inflation is under control. Government is spending huge money on infrastructure. Housing demand is booming. Overall, consumers are able to spend more money. So we anticipate good demand growth in all our segments this year.
Okay. And what are you guiding for in terms of, say, your plastics margin? Because that has really led to improvement and your consumer segment, but plastics has risen almost 400 basis points on a year-on-year basis. Will that sustain? Plastics margin being at around 19 to 20%?
Plastic piping, you are talking?
The plastic segment, that would probably include piping.
Yeah, piping segment for the year, we anticipate that we may do a turnover around 8,000 crore and we may earn around 13%.
Okay. Sir, any pockets of weakness, softness?
No, we do not see this year is going to be a good year.
Good year. And
So
any
now-
other head?
Now our 3 new plants have also started running.
Yes.
And whatever capacity expanded, all are running now. So we anticipate good business growth this year.
Oh, and what's your capacity utilization on the expanded capacity?
Now our capacity has gone up to 800,000 tons. And as I told you that we may be selling around 580,000 tons. So it is going to be 70% of the capacity.
Got it.
Okay. All right, Mr. Taparia, we're going to wrap it up on that note. Thank you very much for joining in and talking to us. So that is Supreme Industries' strong margin expansion that they've seen. And this happened despite a drop in polymer prices, which was quite significant. The volume seemed to have made up for it. Take a short break. On the other side, more stocks.
Welcome back. On our spotlight today is Laurus Laboratories. Well, the company came out with numbers yesterday. It looked like a weak set of numbers, but Ekta, today the stock is doing well. We had a chat with the management. What's the narrative on the street now, which explains the recovery in the stock?
Well, the narrative on the street is that the stock has fallen 50% from its 52-week high. So, there's maybe a bottom created for the company or in terms of the fundamentals. So that's the reason why you're probably seeing this sort of upside come through. Now, in terms of the brokerages, they're still cautious. For example, Jefferies has downgraded it to underperform from hold. They've cut the target price to 250. According to them, Laurus missed their estimates for the 3rd consecutive quarter, but the company expects improvement for the second half of FY24. Similarly, Antique maintains a hold, cut the target price. Transition from antiretroviral to non-antiretroviral will result in a challenging FY24. EBITDA margin from the first half of FY24, according to them, will improve. Now, the company has also told us that they expect FY24 to be a year of consolidation, but they don't expect a decline in revenue. They expect some amount of margin improvement here on. They would look to revert to the aspirational EBITDA by FY25 and reach 25% in FY24 itself. And they have good visibility. Uncertainties of FY23 are over. The other point is that the stock itself is down over 50% from its 52-week high. It's corrected significantly. And the street has been watching the fact that, the company has not delivered on its guidance, revised its guidance from, say, $1 billion in terms of a revenue target to achieving around 6,000 plus crores in FY23 at the end of it. So they have been tracking it. And, a lot of that bad news is already factored in to some level. So if you look at it on an FY24 PE, it's trading at around 26 to 27 times. FY25 trading at around 23 times. So maybe
and
there's
how
some
are these
amount of
valuations compared to its own relative history or other pharma names?
It used to, at one point in time, if you just look at its 52-week high, it was over
Would have been
600
double,
rupees.
yeah.
So that's the kind of valuation reduction that Laurus Labs has gone through. And, you know, EPS cuts as well, consequently, as the fundamentals have actually not delivered for the company. So yes, it used to be at very heightened valuations, and that was also during COVID times because they were supplying Paxlovid generic, you know, the COVID-19 drug which Pfizer created. So all of that has come undone for the company, and hence there is a reorientation in terms of what they can deliver.
So has the bottom been formed for Laurus Laboratories? That's the big question now. But thank you, Ekta, for highlighting what's going on in Laurus Laboratories and how the stock is currently positioned in the investor's mind. Out of time on Midcap Radar. Thank you for watching your stocks when we return.